In this video, I want to show you how I trade put credit spreads and credit spreads in general, risking very little amounts of money. For example, in this trade, I can make $15 and only risk $35. This return would be about 40%, almost a 50% return in about 43 days. As you can see, I'm opening this trade for 43 days out. So if you're trying to grow a small portfolio trading options, you clicked the right video. Now look, this video is going to cover cheap credit spreads, okay? I'm going to be showing you some of my favorite stocks for doing cheap credit spreads and how I would go about managing, closing, and making money with credit spreads. Of course, I'm going to be aiming to show you how to have the highest win ratio, high win rates, and a very low amount of risk. In this example right here, if American Airlines goes down, this position would start to hurt only if it were to go down to $11.50. That's because, as you can see right now, I have opened up an 11.5 put. This is one that I have sold. So I have sold this put, and basically I have then bought a put lower. So I sold an 11.5 and I bought an 11. This is a very tight spread, and this is not typical of what I like to do, because a tight spread like this could have some problems with the bid-ask spread. So if I expand this, you will see here that the bid-ask spread is pretty wide. Now, another reason it's pretty wide is because the market just opened up. So this is not really indicative of opening up this spread. However, in this example, this is a very profitable spread to open. What I typically like to do is I like to open up spreads that are about $5 in difference, okay? That's a $5 width. The reason why I like $5 is I have found that it is a sweet spot for both a good return as well as a good risk. Because of course, you've probably experienced this, or you know someone that experienced one loser can kill all of the returns of even many winners. So pay attention, because how you manage a spread is really important. If you get it wrong, well, your profits are not going to be that much. You always want to look for a stock that has really good support. You want to find where the support line is. So for example, if I go to Apple and I go to, let's just say we do year to date. Year to date, Apple is showing some really good support, especially here at the $169 level. So the stock has bounced up a little bit and down, of course, but overall it's showing a really strong sign of support. Therefore, this is a good indicator, and also just a good stock in general, because when you sell a put credit spread, for example, and you collect income right away, you want to make sure that that income is yours and the position doesn't go against you. You can't always control if the stock goes against you or goes down, but you ideally want to pick a stock with really strong support. Therefore, if it does go down, it doesn't go down by that much, and it doesn't go into your strike zone. So for example, if I were to trade Apple, you can see here that it has very strong support right now at $168 per share. It's basically trading at a year-to-date low. So you definitely want to find a stock that is either at a 52-week low or at a 3-month low. You want it to be below the moving average. You just want it to be sold off. You want a stock to be valued cheaply. Whether that's the support level, whether that's other indicators, you want to find a stock that you really like. Okay, so I'm going to go to sell, put. Now for expiration day, you can go for numerous different expirations. For me, I prefer 2 to 6 weeks. Now you can also go for really short-term one-day trades. That's fine. You can also go really long-term. If you go long-term, that's also okay, but the sweet spot again is in the middle. Don't go for extremes. So you can go for something like 15 days out, okay? That's basically 2 weeks. Now, what you can do is, obviously you can sell something that's really close to the money. You can be aggressive. You can actually have a really high return here, but the risk wouldn't be so low. So if I were to sell a 167.5 put right here, and I were to buy the 165, you know, I've seen traders do this. You know, when I was working on Wall Street, I would see some traders basically going for higher risk, higher reward. And yes, sometimes they would have big days. I mean, I've sat next to a trader that's had a $156,000 gain in one day. I mean, he was a very aggressive trader, but he also had plenty of down days. And in fact, he would have multiple days where he would just lose $15,000, $18,000. I've seen him lose $28,000 once in a single day. So, you know, that's pretty bad, because that's his living, right? Every single day he's trying to make money, and he also has expense to sit on the New York Stock Exchange. But anyways, long story short, you can go for more aggressive plays. So for example, right here, you will see that the max profit is $103 and you're risking $147. But the chances of loss here are just a little bit too high. As you can see, the break even is right here at 166.47, which is okay. I mean, this is not a bad trade by no means. But what I would do instead is I would just go a little bit out of the money. So one thing that I learned at Goldman Sachs was that going out of the money and just selling out of the money options in general works. I mean, I've seen it Not just at Goldman, I've also seen it through my own research. I've seen it through asking my professors back a long time ago when I was studying finance, doing research, and I had access to Bloomberg. I had access to other softwares where I was really deeply diving into backtesting. So backtesting option strategies that make money. And overall, what I saw was when I'm going to go for a put credit spread, I want to go for something that's out of the money. Ideally, it's a 20 delta, however, or even less, even a 15 delta. But I will say that something like Apple that has good support, I would go more aggressive. So you can adjust the strategy. You don't always want to just go for 14 or 15 delta. You can also dial up the risk a little bit and use appropriate position sizing and asset allocation. This is something that is not talked about YouTube because frankly, people don't understand risk management. They don't have a finance degree, they haven't worked on Wall Street as long as I have. You really need to understand that risk management is the most important thing for any strategy. If you're doing spreads, especially because at the end of the day, a spread is a good growth strategy. It is amazing. It uses a small amount of money. You can risk $50. You can even risk $35 as the example that I just showed you. But the problem is it is not as safe as just selling a put or going after some safer strategies. A put credit spread is a medium risk, high reward strategy. Because of this, you need to make sure that you don't put too much into a single position. So here's what I would personally do. I would sell a 165 put option right here, and you can go down to 162.5, for example. But for me, I prefer to go down to 160. Now, some people say, well, why don't you just do 2 times more, the 165, the 162, right? Why don't you do 10 of these instead of 5 of these? Well, it really kind of depends. Let's look at both scenarios, okay? First of all, let's just look at the $2.50 spread. Here, the maximum profit is 83, and the maximum loss is 172. This is about a 50% return, okay? So ask yourself and tell me, why do you think this right now has a lower return? Why is this not 50%? Why is this lower? So think about it. I'll give you the answer right now. The reason why the 160 is lower, right? Why this spread is actually giving you a lower profit. You may think to yourself, well, wow, this is not a good of a trade. Actually, you would be wrong. This is actually a better trade. The reason why it's better is there's a higher chance that Apple could go down to 162.5 than it can go down to 160. 160 is less likely, meaning this is actually safer, okay? If you were to do 10 of these and Apple went down to 162.5, you would lose 100% of the spread, okay? Now, if it went down to 162.5, but you have the current position, which I have here open, 165, 160, you will only lose 50%. And in fact, you would have a pretty small loss, well, relatively small, because you're collecting 142, and it would be down to 250. So your actual loss wouldn't be as much. It would not even be close to 100%. It wouldn't even be 50%. So in this scenario right here, I prefer to do $5 spreads. Now, of course, it's really important to understand the direction of the stock because the direction is the most important thing to make money. Now, you naturally want a high win rate. So the more you go out of the money, the lower you go, the higher you will have as your natural win rate. And that's because normally stocks move up, down, but on average, they're going to move about nowhere. They're going to go sideways. So in a 2-week period, if you're selling out of the money options, you are going to have a naturally high win rate. You are definitely going to win more than 50%. In fact, if I show you the delta right here, you are expected to win this 65% of the time. That's because the delta is 35, so there's a chance of 35% chance of this happening and a 65% chance of this not happening. So if you want to make consistent income, you will go for out of the money options. However, if you want to have a big income, you go closer to the money. So you need to find a balance, and this is exactly why I do have a Discord community, and I'm always trading and teaching you because you need to find balance. There is no perfect rule to trading. Anybody that says they have a perfect formula to trading is completely lying. You need to understand this game is very similar to sports, to life, to mathematics, and to art. You need to have intuition, experience, and you need to understand and learn from your mistakes consistently. So look, when you set this position up, here's how you would manage it. Once you have set this position, the best way to manage this position is by leaving it alone. You can monitor it for sure, you can take a look at it, but ideally what happens is the stock does not go down into your red area. Now, it can go down a little bit and you may want to close it. However, I would urge you or recommend you not to close this position because in my experience and from the research that I have done, it is a bigger return and I have a larger raw return, okay? I'm not saying volatility. The volatility is higher, the risk is potentially higher, but you have the biggest raw return, the best results when you do hold until expiration. You want to let options time decay kick in because a put credit spread is a selling strategy. It is a credit. You are collecting a credit. You are making money instantaneously. So when you open up this trade, you immediately get $142. Now, what you want to do though, your account won't reflect that because you now have a negative $142 position in your portfolio. What you need to happen is you need time decay to kick in. You need the option to start losing value. As it loses value, that's really good because you can buy this position back anytime that you wish. You can make a profit. However, again, I would recommend you that you just wait until expiration. So if you wait the full 15 days and Apple is above 165, then you end up collecting the full amount of money. But look, the full amount of money that you collect is already yours, but now the position actually leaves your account, nothing else happens, and you can do this again. And you can basically do this position many times. I have gotten a question about rolling this position from my students, and I want to mention that rolling this play can be very profitable. However, rolling a position and adjusting a position can be expensive. I can show you an example right now. We can look into my portfolio currently and pick out a trade that may not be going in my favor. I'm not sure if I currently have any of those because I currently have a win on Amazon, a win on Meta, a win on Nvidia. I'm trying to find a spread. Okay, this is a good spread right here, okay? This is a spread where I'm losing money. I have some other winners right here. This is a good spread. Okay, so let's look at Tesla. Now look, Tesla is taking a nosedive. It's currently in the money, so this is going to be perfect. If you want to see me roll this and how I use risk management and adjust this position, this is a perfect example, especially because Tesla, let's just take a look at Tesla real quick. Tesla has recently really fallen down. I mean, the stock is taking a tumble for a number of reasons. They do have earnings coming up in 5 days. And overall, my position, which is not that big of a position, is down a decent amount. I'm down $1,260. So this position actually expires tomorrow, which is pretty interesting. So this is actually a perfect time to adjust and roll this position. So look, I can just let it expire. I will lose some money, okay? Or what I can do is I can close this position and open up another position, okay? Now, some platforms will let you roll a spread, some won't. Right here, I cannot, okay? I'm just gonna go for an example. Pretend that I'm gonna close this trade right now. So I'm gonna close this trade, for example. I will incur a $2,304. Basically, that's how much it costs, but although I did collect income. So if you look here, I collected $1,360 when I opened this up a couple of weeks ago. And now it's worth this much. So my total loss is exactly negative, $1,000. All right, so this is what I can do. I can, first of all, I can close that trade for negative 1,000 and I can then sell another put. Now, because Tesla has earnings, I will probably hold this until tomorrow. And if Tesla comes up tomorrow, then I'll do it. So I'm not actually gonna close in this video. Just we can just pretend that I closed that $1,000 for a $1,000 loss. Personally, I would hold one more day until expiration. But okay, so let's say I close this trade, or let's say it's tomorrow, and tomorrow I'm closing this trade, and I can go for a future date. So let's say that I go for June 21. What I would do now is I would open up a very similar trade, but my first trade right now is 150, 140. Now what I can do is I can go for a 140, so I could sell, and then go for a 130, okay? This is basically rolling down. Now, if I go to continue and I go to 10 contracts, you'll actually see here that I am way more than making up for the cost of buying back those shares. In fact, I'm losing $1,000 or $980, but I'm making $3,250. So in this video, you're really understanding how I think about spreads, because not only is it important to open up a spread properly with a stock that has support, it's important to have a high win rate. It's important to risk low amounts of money. It's important to specifically go for a spread that's 5, or in this case, it's $10 spread. It's 140 to 130. I decided to go a little bit more. It's also very important to understand how to manage and close a position. So the other position you can simply close, and as you can see here, I'm not closing it because I'm still bullish on Tesla a bit, and it's kind of popping up here now above 150. So my loss is going to be less than 1,000 right now. My loss is only 750. So you can see why I don't want to close it, because I still personally have belief that this position is going to go well. So I am not closing it at the moment. I'm going to wait until, basically close of tomorrow. I'm not going to rush this position whatsoever. I'm going to keep monitoring the total return here. And I am actually expecting to come out as a winner. Now, again, I don't really know. Nobody knows. But for me, I've had better results. So I'm going to hold this position and wait. But going back, if I go back here to the position that we did have open, you can see that it was pretty favorable to go for a June 21. So going back to the June 21, and I go to the sell, we had a 140. We had 140, 130. This is going down. So instead of 150, now I'm going to 140. So you can see here the break even is 136, whereas in the other scenario, my break even was a lot higher. It was like 149 or it was 150, right? So I'm moving down from 150 to 140 and from 140 to 130. This is how you would roll a put credit spread, save yourself an issue of actually having any problems with assignment. And an assignment can happen. It's not that likely. It does become more likely if the stock, is between the two strike prices. So for example, if Tesla was at 136 right here, they would be between 140 and 130, and it's the last day of expiration. You have a high risk actually of assignment. You want to close that position. So I like to close the day of expiration, the day before, or the day of. In this example, I'm going to go for the day of. So I'm going to wait until tomorrow. So the total credit here is $3. So you're making a lot of money. And if I go for 10 shares again, you can see that I'm making over $3,000. And this is how I make money trading credit spreads, only risking sometimes $50, $100, or a really small amount of money, but still having a really high return, low risk. And even if the worst comes to worst, I have rolling and adjusting positions in my arsenal. If you want more help, you can check out my description. I'll have a few links there for my Discord community, my ebook, and more resources for you to learn. Take this stuff really seriously. You can make a lot of money. And if you need another video on spreads and spread management and my ultimate guide, watch this video right here on the screen.